All right. G'day, everyone. Welcome back to another episode of Spark Your Fire. I'm your host, David Shee. And as always, got the lovely John Camino with me again, back from your Europe trip. John.
Yes. Nice to see you again, David. And yeah, we were in Greece for 3 weeks in Corfu. If any of the listeners know where that is, and it's one of the bigger islands. And we were there for nearly 3 weeks. And
Okay, nice.
Corfu return. Actually, we just came straight back, so we didn't travel around. We commodos don't travel light with all the kids and everything. But we had a good time. Yeah, had a lovely
Like
time.
to stay in Greece. Greece weather will be a lot better than
Yeah,
Sydney.
it was hot. It was great. It was great. The tan is slowly starting to wash off, but
I can't see too much
the
tan from you,
remnants.
John. That's
No,
it.
I know. It's gone. It's gone. But we had a wonderful time.
I wonder what a tanned John would look like, as a matter of fact. I haven't actually seen one.
Unrecognizable. Yep. Yep.
Might be a completely different person. But
Yes, that's right. Yeah.
welcome back and hope you had a lovely time there with the family, mate. It's a well-deserved trip, that's for sure. Holiday. Beautiful. All right. Well, look, as always, it's an interesting time in property, I gotta say. And we definitely should be kicking off this episode talking about potentially RBA's decision next week, because we are recording this on the 2nd of August, and
Yeah.
RBA is grouping together on coming Monday and Tuesday, potentially to make a decision on whether there is going to be any changes to cash rates. So, John, let's touch on that a little bit. Obviously, a few factors that most people will be aware of. The CPI data that got released earlier this week includes the quarterly and the monthly CPI. So I think the monthly CPI was about 1% and the trimmed quarterly CPI was about 0.8. So they actually both came in below expectations, is how I'm reading it. And funny enough, as we know how many times the economists change their views based on the latest day roll,
Right.
it was literally a 180, right? Beforehand,
Yep.
everyone's kind of putting their bets on, hey, there will be another potential rate rise in September, as early as September. Whereas right
Yep.
now, everyone's kind of like, change from red to black and go, well, no, rate rise is completely off the table. Now, John, I know you know a lot more about economics than I do. So don't give me that look.
Okay.
Why do you think so tell us what your thoughts here. Why is the quarterly trimmed CPI has such a big impact in terms of RBA's rate decision?
Yeah, there was a lot of speculation. There was speculation that they were going to need to raise rates and that they weren't getting on top of inflation. And now when the numbers came out, the Aussie dollar tanked, which means that the market was expecting interest rates to be, inflation to be a bit higher. So they came in below expectations. I think that this podcast, we never thought that they were going to raise interest rates. We thought that the CPI was on the right track, and that's turned out to be true. But I think that the reason there's been speculation is because Australia started raising rates after the rest of our peers, after the rest of the world. So, for example, New Zealand started raising rates in October 2021, and we started raising rates in May 2022, which is, what's that, 9 months? There's a substantial difference.
Yes.
New Zealand's in a recession now, along with the UK and a couple of other similar markets, which is to say that by moving later, and we didn't move as high, there was speculation that we had been a bit cowardly. The RBA had been a bit cowardly in its response to inflation, but actually, and that may be a legitimate criticism, but it's actually that New Zealand it moved early. It's in a recession. It's a bit of a hard landing, actually, particularly in the property markets. I think there's speculation that our turn is coming. We're going to have a hard landing as well, but it's just going to be 9 months after the rest of the world. So the CPI data confirmed that things were moving in the direction of lower inflation. And at the very least, we can debate hard versus soft landings or no landing, but at least a rate rise is off the table now. And that calmed markets, but it did hurt the Aussie dollar.
Yeah. Now, funny enough, you mentioned about New Zealand, because I was talking to a Kiwi client the other day, and I was just basically asking him, how's New Zealand property market doing? He's saying terrible.
Yep.
It's absolutely terrible. Like they're literally coming down 20%, 30% from their peak. And that's partly because of their lending criteria. You know, they've been very stringent in terms of lending to investors. I think only like 60% or 70% LVR is the max, which is terrible. So you
Yeah.
need to come up with a huge number of deposit in order to be able to get in addition with the high interest rate. So coupling that, you know, that kind of shows the impact of this. So, but I'm certainly getting my fingers crossed that Australia is not going to follow that, and we're not going to see a hard landing with the property markets. Not
Yep.
probably not with the demand or not with the amount of people that's currently that's still needing a roof over their head at the moment, whether that's renting or buying. I think it's just the demand way outweighs supply in terms of what we can. So
Yeah.
fingers crossed we're not going to see something similar to New Zealand.
Yeah.
But you're right. I think the you know, you're definitely we lag, or RBA has lagged in terms of the response in increasing the cash rate in
Yeah.
comparison to the rest of the world. But that also means at the same time, I think they don't have to do as much to a degree if you look at it from the other view, right? They don't have to pull out, they don't have to increase as much, and at the same time, they probably don't have to reduce that much.
Yes.
We're likely to be seeing, I think New Zealand's already started dropping their first cash
Yes.
rates, right?
Canada, UK. Yeah.
Correct. Same with UK and all that. And Fed is almost coming there as well. I think
Yep.
potentially as early as September at this point in time. So, you know, the rest of the countries, the ones, especially the ones that started early, have now starting to turn around.
Yep.
Whereas for us, we are probably 5 to 6 months lagging on that
Yeah.
perspective,
That's right.
right? So,
So the Fed will cut in September. I mean, so the Fed, the FOMC meeting was, I think, 2 days ago, and Chairman Powell said a September rate cut is on the table. Now, the markets had anticipated a 100% chance of a September rate cut in the US, but Powell confirmed it. I mean, as much as you can confirm a rate cut,
yeah.
he said that that's likely. And then last night there was some really bad employment numbers. The official unemployment number will come out tonight, and you'll expect to see that's probably bad as well. So the US is locked and loaded for a rate cut in September. And you're right, if we're 5 months behind, 5 to 9 months behind, we'll start cutting rates in probably February, maybe March,
Yeah.
and then our cycle will begin as well. So, but rate rises are off the table. China's been cutting rates as well, I should note, and there's lots of challenges out there, and I think, you know, what the US has to weigh up is that there are some problems in the US, as there are everywhere, although the US is probably the cleanest dirty shirt. But it's also an election year, and so they're probably not going to put their finger on the scales too much. And, you know, they go to the polls, I think, on the 5th of November. A rate cut in September is probably encouraging for an incumbent, and they're going to want to try to be as neutral as possible. Just one other thing, just really quickly on supply. So again, in Australia, we've got massive supply issues. So there's, you know, even though rates have been rising, we've still seen the property market go up, and like it's almost inexplicable if you take into account high rates, cost of living pressures, the flat incomes, or the amount of income it takes to service a loan is starting to stretch out as well, and then like even so, you know, lending criteria is tight. So why would property prices have been going up in that environment? And the reason is supply and demand. That's the main reason. There's another reason as well, but the supply and demand. So supply is down for a couple of reasons, but the main reason is that higher interest rates kill off demand for debt, but it also kills off supply for anything that requires debt to build. So it kills off, it hurts property developers and the supply thereof. Also, the cost of living pressures, again, it hurts demand, but it also discourages property developers from engaging in, say, a 3 or 4 year project to bring new properties online. So we always sort of forget the supply side of these policies. So they're the reasons why, you know, the amount of listings is down nearly 6 or 7% in Sydney alone. It's down like 20% in Perth and Adelaide. Just really, really tight over there. And then to make a final point, you layer in population growth. Now, big fan of population growth. However, it's been really erratic. So if you look at population growth this century, during COVID, you've got population growth going to 0 or negative, and then up to like 750,000 in 1 year. Now, 750,000 for our listeners is two Canberras in 1 year. It's like it's a lot of people, a lot of people. And so, if it was 750,000 people every year, the market would know how to figure that out.
Right.
It would be able to plan for that. But if it's zero 1 year and 750,000 the next, there's no market that's that efficient. And so, we talk about high population growth, and that's a thing, but it's actually erratic population growth that's the problem. And so the property developers don't know how many units to build, and councils don't know how many units to approve, and so on. And then you've got cost of living issues. So we've got genuine supply issues that aren't going away soon. And so while the property market's a little bit flat at the moment, it's unlikely to go down in any meaningful way.
Yeah, no, it's spot on, John. I think same. I mean, as much as in New South Wales, the Minsk government has approved the transport-oriented corridors, to allow most of the 400 meters within a certain number of
Mm,
stations to be able to do high rises or build, to fast track essentially constructions. But I don't think the numbers will stack up for developers, and that's the main issue at the moment. So yes, while the policy has relaxed, but the numbers don't add up. Like the developers are not dumb; they're not going to buy block of
no,
lands for premium and then just to lose money
that's
ultimately,
right.
right? So because that way they're going to go bust. So why would they do that? So I think that's one of the issues, and I think that the building or the construction approvals is actually at a historical low as
Yeah,
at this point in time as well. So unfortunately, the supply issue, like you said, is not going to go away in the short to
yeah.
medium term. So
Mm.
fundamentally, I think that's what's really, really getting us the baselining what our property values
Yeah,
and why it's holding so firm at this point in time. So
yeah.
okay, so that's interesting. Hey, speaking of which,
Mm.
you're always a big advocate in terms of the bond yield as an early indicator on the
Oh yeah.
interest rate. So worthwhile, what are we looking at a 10-year bond yield at the moment?
That's my favorite one. So the 10-year bond, the 10-year yield
Mm.
crashed after the Chairman Powell statement. So the US 10-year yield, which is the one that we all should be looking at, that plus the 2-year, the 10-year yield's below. It dropped about 20 basis points in a day. I mean,
It's
it's
below
below
4%.
4%.
Mm.
It's below 4%. It hasn't been 4% for a year. So the market is locked, loaded, ready to start cutting rates. And even at the long end, it's coming down. The short end, the 2 years dropping really quickly. Now, so just a super quick thing. So the yield curve has been inverted, which is to say the 2-year yield has been higher than the 10-year yield, which should be
Mm.
the other way around. So,
Mm.
and an inverted yield curve is like a 100% harbinger for a recession. So it's predicted every recession. So, but the yield curve has been inverted for like a couple of years now, and usually the yield curve inverts for brief periods of time. There's a recession, and then we move on.
Yes.
But it's been inverted for a couple of years. So everyone's saying, well, maybe the yield curve didn't predict the recession. The yield, it's only when the yield curve uh, flattens and steepens again, as in it's when the yield curve corrects or when they start dropping rates, that's when the recession happens. So if the short end is coming down and the yield curve is starting to restore its normal shape, that means a recession is quite close.
Mm.
So that's another interesting thing, that the yield curve is predicting a recession, and timing wise, it must be getting close because the yield curve is starting to restore.
I think it's the same thing with looking. I mean, that's the US data, but looking at Australia, we are pretty much at the same
Yeah,
side of things as
yeah,
well, right? Like,
yeah,
there's literally no GDP growth for the last quarter whatsoever as well.
yeah,
So, and that's one of the main concerns as well in terms of why RBA would be hesitant to actually increase rates again, because they know the small business are already suffering, and there will be
yeah,
more small business that's going down. Like this week, I think Rex Airlines has already gone into voluntary administration as well, right? They're one of the regional express carriers. And after Bonza, who just gone bust in 3 months ago, now they're basically following suit. So these small businesses are absolutely on dire straight terms at the moment. So
mm,
and RBA knows that very, very well in terms of, they want to hold on that. I think they have a tendency to actually cut rates, but they can't say that, of course. But they're hoping that we can hold on as long as we possibly can until they're out of the woods. And the main sticking point is CPI. So as soon as CPI is starting to come down, which I think John, would you agree that Australian CPI kind of follows what the US has gone? Because the US has gone for a sticky point as well. I think there was a sticky point maybe about 6 months prior to us where they actually kind of
Yes.
reared its ugly head a little bit.
Yep.
And then it's now on a downward slope
Correct.
again. Do you
Correct.
reckon we're going to follow something similar to that?
Yeah. Yeah. Yes, I think with less amplitude though, because you quite rightly pointed out earlier that we never kind of cut as low, we never raised as high as we should have. So
Yeah.
whatever recession we have is probably going to be milder, perhaps. But yes, I think that the CPI will come down in the same pattern, but maybe a little bit slower.
Mm.
But yeah, interesting. Just on last kind of point on the CPI is being held a little bit higher than perhaps is the RBA is comfortable with, even though it was below
Yes,
expectations,
that's
based on
true.
what they call housing costs, which is essentially rent. Rents, anecdotally, are flattening out and starting to come down. So give it some time to feed into the CPI, but if rents are coming down, what we're going to start to see is the CPI start to drop. And I think Stephen Koukoulas, if I've got his name right, so he's this fantastic sort of economist, and don't agree with everything, but who does agree with everything, everyone and everything? But he's saying once he said that if CPI is zero in the third quarter, so the quarter we're going into,
Mm.
by the end of the third quarter, the annual CPI rate will be 2.6%, bang in the range. Rate cuts are coming. So he says we've got to get through the third quarter where you're just going to start to see lower rent prices, and CPI will be nearly zero, and the annual rate will correct itself then. So shout out to Stephen Koukoulas.
Fingers crossed that'll be the case. I think,
Yeah.
a lot of our listeners will be happy to hear that. At least there's no more rate rises on the table. Fingers crossed. That's
Yeah.
what the most of the economists are banging on at the moment. And potentially the next move will be down instead of up. The
Yep.
question is just when and how quickly CPI starts to go
Yeah.
down and goes back into the trend of 2 to 3%. Yeah. Okay. Which is actually a good segue, John. I think you talked about rent starting to moderate and starting to drop. What are you seeing at the moment? What's been happening this week? What's the goss on the property side of
What's the
things?
goss? So I'll kind of tie my own anecdotal kind of knowledge into what
Sure.
I know is coming out of the numbers, and so Sydney is, so Australia's still going up by about 0.5% a month.
Mm.
Sydney's really tapered off, so
Hmm.
we're going up at about 0.3%. I think units are starting to come down a little bit,
Yes.
and I think houses are still okay, but Sydney is basically flat at the moment. Fine. Within the regions, the western suburbs, the northwest and the North Shore are flat to sort of coming back a little bit.
Okay.
The
Pulling
eastern
back. Yep.
suburbs is flat as well.
Okay.
What is booming in Sydney is the southwest. The southwest corridor is going gangbusters. I bought a property in Wiley Park about a couple of weeks ago, just before I went overseas, actually, and it was hot. It was hot, hot, hot. Um, and
Units or houses?
Pardon me,
Units or houses
that was a unit.
in Wiley Park.
Unit, yeah, yep, yep.
Affordability.
And you pay approximately 400,000, you get approximately $500 a week in rent, so you're pulling out 6.5% yields, and there were. It's the only time I've seen recently lines out the front of an inspection,
Wow.
so really really busy. Um, but it actually ties into the southwest corridor. So the southwest from Bankstown, which is sort of in the southwest, or even Wiley Park, Belmore, out to Liverpool and then out to Campbelltown, that corridor is doing really well. Lots of public infrastructure with the metro, but also the best way to play Badgerys Creek would be Liverpool as well. So I think that a lot of money is going into Liverpool to be able to take advantage of the Badgerys Creek. So that's what we're seeing. Houses are still doing well, but I mean, I've always felt that units, it's time. It's time for you. We just don't have enough units, but I'm not seeing the price of units explode. But that part of Sydney is definitely doing well. That's what I'm seeing. Uh, Rents anecdotally are coming off and starting to go down.
Yes. Yes.
I didn't mention the inner west. The inner west is still doing very well in Sydney.
In a
Still
way.
doing really well. Yeah. But rents are kind of flattening out as well. The issue with rents is that as a tenant, you're probably not going to feel it that rents aren't going up anymore, because the last time you negotiated a lease was 12 months ago,
Correct.
and rents are still higher than they were 12 months ago. So it kind of depends on when the last rent increase you had was as to whether you feel higher or lower rents now. But generally speaking, that cycle has run its course as well.
Mm, mm. With Southwest Sydney
Mm.
that you mentioned, are you talking about units or houses that's going gangbusters at the moment?
Oh, houses,
House.
houses mainly. I mean, they just dwellings.
Yeah.
But as I said, in that sort of let's say Sydenham to Bankstown corridor, it's everything.
The
It's
metro
units as
corridor,
well.
basically.
Yeah, the metro
The
corridor.
metro
Yeah,
corridor. Yep. Yep.
yeah,
Okay.
yeah, yeah,
But outside of that, it's mainly independent or detached dwellings
yeah,
or houses.
yeah, yeah. That's
Yeah.
right.
And why do you think that's the case? Why is that area, why is only the area booming or going up or being very popular, as
Mhm.
opposed to, let's say, the other areas like the northwest, the eastern, suburb? Is it because of affordability in terms of what people can afford? They can still
Yeah,
get a house for around 1 mil or just a tap between 1 mil to 1.5?
yeah. I just look. The Bankstown area has been left behind,
Mm,
and it only started catching a bid in from about 2017 onwards. Whereas if you compare it to say the Hills District or even further northwest, I mean that has been really strong for a lot longer, and statistically, delivered a lot stronger growth than the Bankstown area. So that Bankstown area and the southwest in general, I think, has largely been left behind up until the last couple of years. So I
understand.
think it's really starting to reassert its value.
Mm,
Um,
mm.
so there's a valuation play. That plus there is a lot of investment out there. It is quite an exciting part of Sydney, and I'm sure Badgerys Creek has got something to do with it as well.
Right. Okay. Okay.
Mm.
Beautiful.
Yeah.
What am I saying? Actually, yeah, I do agree with you.
What
I
are you
think
seeing? Yeah.
anecdotally, rents are starting to slow in terms of the increases. In terms of that, I think that's being reflected as well on the CPI. On the CPI basket. Same thing with Perth. I think the Perth rents, whilst previously was going crazy, now it's starting to kind of get toward a cap as well. So I think
Mm.
it just comes down to affordability. People's income are not going up quickly as what these rents increases are. So, there's only so much they can afford to pay. And now it's getting to that point now, whether it's Sydney or Perth, people can't be stretched anymore. They're already stretched to the maximum. So
Yeah.
they go, well, this is as much as I can pay in terms of a rent. So what else can I do? So,
Mm.
we're close to hitting that ceiling in terms of that rental growth. I think with Perth prices, there's still a bit more to go because there's especially the sub $600,000. The competition is still very very hot. I get clients that constantly getting missing out. I get BAs telling me basically can't get deals unless you go in with like no finance clause, right? If you put in like if you imagine you try to get everything loaded to protect yourself, you're not even going to give it a try, basically.
Yeah.
So the investor corridors, essentially namely Perth, as well as say Townsville, which is the cheaper side of things. Even Townsville at the moment is edging more towards 550, 600K now, whereas beforehand
Yeah.
it was more the 400 or the
Mm.
high 400s now, right? So, and they get snatched up very, very quickly as well. I think the soon we will not see properties that's below $600,000 in Australia.
Yeah. Yeah. Yeah.
That seems to be the trend. Like the minimum has been lifted because of this time. The inflation this round has actually pushed everything up to around 500 to
Mm.
$600,000. So scary thing, in all honesty, because affordability, coupled with borrowing capacity that with high interest rates that people can't borrow as much as they would, we are pretty much stretched. On the positive side of things, though, I mean, the July tax rate cut has now been in place. So, most people are seeing a bit of the borrowing capacity gain. We're looking at generally about 3 to 5% on average. So, for those people who were needing that extra bit of squeeze in terms of their borrowing capacity, they can now kind of get it,
Yep.
which is good. So that would help them get into their next property as well. But yeah, in the last month or so, I think there's just been a lot of sentiment changes because you know how that, previously the economists were saying that the next move on the interest rate could be up. So,
Mm.
and that drives off demand, is what you say, right?
Yeah.
So people kind of sitting more on the fence and going, "Oh, should I have a look or should I just wait and see?" And so on. But now that the economists has changed their bets, it'll be
Yeah.
interesting to see what happens in the next few months, whether the market
Yep.
sentiment would have changed. Sydney in particular is being mostly impacted by it, I would say. So
Mm.
it'll be interesting to see what happens in the next couple of weeks, whether there will be more investors lurking around again, or
Yeah.
just to see what's going on. So
Yeah.
yeah, that's
Yeah. I mean, my kind of view, if I take a 1 year view, is I think that we're kind of flat to the end of the year in Sydney at least.
mm,
And I think that then next year, the rate cutting cycle will
begins.
begin
Mm,
probably. Now, what rate cuts will benefit the lowest yielding markets first. So that market's not going to go into Perth or Brisbane. It'll go into Sydney and Melbourne
mm,
when they're cutting, I think, which
mm,
is why when they were increasing rates, Sydney and Melbourne underperformed the high yielding markets. And I think that will happen in reverse when they start cutting. Um, and I think it's the market's taking a bit of a deep breath, but I don't think I think we're going to crack on with the bull market next year. So I mean, you always want to get it in at the beginning of a rate cutting cycle. It's almost always good, even if it's a recession, and there's probably a recession in the near future. But in recessions, they cut rates. And if you've got population growth and rate cuts, and a shortage of property, you're probably going to get high property prices. Um, yeah. The only other interesting thing is I always talk about the two ingredients you need for a bubble. The first ingredient you need is high supply.
yes.
We don't have that. But the other ingredient you need is a lot of investors. And actually we're getting there. So in Sydney, the amount of investors are about 40% of the market, which is actually higher than average. Usually it's about 35%. So it's not like crazy high, but it's on the high side. So if supply starts to come back in the next couple of years, you will that's a little bit like danger zone because the investor numbers are high, and if that starts to creep up to 50%,
Mm.
then you want to start calling an end to this cycle. But right now, we are nowhere near bubble territory, in my opinion.
Not in a short period of time, that's for sure,
Mm.
given all the reasons that we explained above. Okay, cool. All right. Thanks, John. Thanks for sharing that.
Thank you.
We'll be interested to see what next month brings us, I guess. So
Yeah. Yeah.
let's talk a bit about property. And this time, the topic that we want to tackle is uh, we want to chat about property is actually easy to get in, but difficult to make money out of. So property, let me rephrase. Let me just repeat again. Property is easy to get in, but difficult to make money out of.
Okay.
Okay, so and I think the reason why we say this is, I think it's difficult to make money in property in a short period of time, to a degree, right? If you're
Mm.
looking at just a 2 to 3 year type of horizon, and you want to offload property, chances are you're going to make a loss unless you're in an absolute vertical type of growth phase, right? So you can't bet on it in that sense. But at the same time, I mean, you make mistakes as you get into property. You might be overpaying a little bit, and you're betting on the market to actually help you do
Yeah.
that uplifting in order to make up for that recovery. And whilst property is a very forgiving asset, it could take time, and it could take time. Okay, so and there is a lot of headwinds once you become a landlord. I've recently had one of my Queensland properties that's got ongoing mold issues, and that's now going to take me at least $4,000 and more to actually try to get a fix, and that's not
Mm.
even a permanent fix. That's probably just going to last for a couple of years, right? Um, so, and that involves like installing like fiberglass on the ceiling, and then rescrewing off the actual roof screws. Apparently, I don't even know what roof screws are,
Mm.
but apparently waters are seeking in there. And then repaint the ceiling of the bathrooms again, because that's been ongoing. And every
Yeah.
couple of
Yeah.
months, it's cost me a couple hundred dollars going out. I said, we need a solution to actually get this. So there's a lot of headwinds in terms of people stopping. Because I'll be honest, like firsthand experience, I like, this is annoying. Like, should I just get rid of this property? Brisbane is a good market at the moment. When I look at the valuation of property, I go, oh, okay, sure. And I look at the cost base and how much I paid for it initially. I worked out if I do sell at this price, how much profit I'll have. Hey, I've actually held this property for about 7 years now. After
Right.
I realized the profit, factoring this capital gains tax, I'm actually not going to make much.
Hmm.
So it's actually very, very difficult. Like, I'm no means an expert in terms of investing in property, right? Like, yes, I got a property, but yeah, it's actually difficult to make money out of. That's what I realized, at least in this short period of time. Maybe in 7 to 15 years, or maybe through another cycle, when I
Yeah,
look at
yeah.
assessing this again, I might come to a different conclusion. But not
Mm.
even after I hold the property for 7 years and having all the headaches of tenant issues, repair maintenances, and all that kind of stuff, right? It's yeah, I think I have to agree that it's actually a difficult asset to be making money out of. And I don't know what you think, John. What do you think about this?
We're talking buy and hold.
Correct. Yeah. Buy and
Yeah.
hold.
So I agree. It's a very, I think people have expectations of making money quickly, but think about it. You're only, I mean, long-term returns for the Sydney market, and there I go talking about Sydney again, but it's about 6.5%. Okay. That's pretty benign. I mean, that's not that impressive. Um, what that means is you have to wait for compounding to do its thing. But compounding takes decades. So you need you're not making money until the second 10 years of ownership, really, where you let's say, and let's face it, you're just getting in, we're all just getting in the inflation rate.
Correct.
Unless you kind of get a hot market with a big infrastructure infusion, you're basically just getting inflation.
Yes.
Um, and so inflation compounded is essentially what you're going to get,
Yes.
and perhaps you could say plus the leverage. Okay, but again, these are again, with leverage you can move the earth. However, you need to let it do its thing. So how important is 6% annualized growth to you? Well, depends how long you've got. And I think that this is why I wrote an article on my website called The Second 10 Years. And it was essentially talking about this. It was talking about how nothing is going to happen for you in the first 10 years that's meaningful to your wealth, because you'll get capital growth in the first 10 years. You might even double your money.
Mm,
However, everything else in the economy will have doubled as well.
correct.
And so, but the longer you hold it, it goes, I think it's parabolic, right? Not exponential, parabolic.
Parabolic.
And so you need to hold it long enough for compound interest to do its thing. Coupled with that, you really should be chipping away at some debt to give you a little bit more than inflationary returns, because
Mm,
that's sort of feeding into your equity.
mm.
Um, but yes, property just delivers single digit returns plus rent.
Plus all the
Um,
headaches that goes with it at the
Plus
same
the headaches. So we had a hot water system breakdown this month for us as well. So it's always
time.
something, and it's just you see people get fed up and decide it's not for them. But you have to hold it until the second 10 years. Um, yeah. What do you think? I mean, what the wording used was it's easy to get in, but it's hard to make money out of.
Correct. Yeah.
So why do you think that is? Is it because property's not really a passive asset? It's an active asset, and people think it's passive. Maybe.
You probably have to look at it from a short, medium, and long-term perspective
Mm,
to answer that question, right? Like you said, I think people's expectation, especially in the fast-paced world today, you want instant returns. I want ROI, right? Like I've got a client that told me he bought a property in Perth, and literally for the last 6 months, it's just things just going wrong, and then he keeps on sinking in money. He sinks on sinking money.
mm,
He said this property hasn't even given me a single dollar so far, right? From a cash flow perspective.
yeah.
But from a growth side of things perspective, yes, it probably had. So there's an
Mm,
intrinsic side of things which hasn't really given you, which you can't see, and it's not tangible because you haven't realized that profit yet. But just from a cash flow perspective, he's like, oh, like it's giving me so much headache, and I've only owned it for like less than 12 months, and
yeah.
this broke, this broke, this broke, and I had to chip in all these money, right? So that gives the perception of it's actually very difficult to hold on to and difficult to make money out of,
Mm,
because hey, number one, the expectation is it's a passive property, right? Like, hey, rent comes in, interest repayment goes out, that's it, done deal. But added to that, a lot of people are not aware of is, hey, there is actually a lot of maintenance, and you need to be involved with. So
mm,
never a passive investment. It's always an active investment. You need to be on top of it as well.
yeah.
Okay, so that's kind of like the short term. Now, coming to the medium term, like anything between say 2 to 10 years, like you mentioned, yes, the property capital growth would have potentially doubled, but there's a lot of instances where it may not have doubled as well, depending on the area. It
Yes.
could even, in a worst case, go into say mining examples, where it's actually pulled back
Yeah.
50%. right?
Or some
So
apartments. Yeah.
yeah, or some apartments which stay stagnant or
Yeah.
literally like, I don't know, 50K or 100K higher than what they originally got it for.
Mm,
Plenty of examples in Sydney that actually did that.
yes.
And what at that point in time, that's actually, I think when I look at it, the medium term is actually a very, very important turning point for a lot of property investors as they think about it, because that's around the time when they go, you know what, I had kind of had enough of this property. It's giving me all these issues. Oh, how much return have I got? Similar to the example that I just got.
Mm,
Oh, not much. Okay. That's because you just start on the compounding path. Okay. And
yes.
I think unfortunately, most of the property investors actually decided to exit at that point in time because they just had enough. Okay. Whether that's, oh, it's not growing as quickly as I wanted to. So it's a dart asset, getting rid of it. Let me put my money into somewhere else. And then they put obviously sell that, take the profit. So they don't have enough patience to be able to do that, or for other reasons, or even I gotta say, like, if it's under personal, like for any personal reason, for medical reasons or something, for some reason that's beyond your control, that you actually need to sell those properties, even though you don't want to, you still have to take the profit. There's so many examples which can actually stop people from be able to make more money out of it.
Mm,
Okay, so yeah, that's the medium term. I gotta say, which is why it's making it really, really challenging, because the key, as you said, compounding growth requires you to actually hold long term, and you really only see compounding growth kicking in after year 10 onwards, literally
I
the second cycle.
totally agree.
Yeah, so that's the long term, right? How many investors can actually hold onto a property that long without going too hard?
Yeah.
That's the tricky part. And I think that's one of the reasons why a lot of property investors and, people just don't have that patience. And number two, don't have that resilience and in order to just go, sure, I'll stick with it. And, I'll just keep holding on to it. The best way I can think of is just, when you hold an asset, just leave it there. As long as there's no issue, just forget about it. Like I've said, I
Yeah.
just forget about it, right? You're not selling the property today. As long as the tenant's paying rent, keep it there. Just
Yeah.
just keep and life goes on. Do your stuff and
Yeah.
continue to grow yourself, and whether that's from an income perspective or personal development level.
Yeah.
Forget about the properties that you had. But obviously be on top of it. Don't when there's maintenance coming in, don't forget about them. Don't ignore them. You do need to take care of it because you as a landlord, you have the responsibility to look after and provide a safe and sound housing for your tenant.
Yes.
That's one-on-one requirement. But from an investment perspective, don't worry too much about the return on investment in the short term or the
Yes.
term.
Yes. Because all
That's
your
probably
money's
the
been
key.
made in the second 10 years. Yeah.
Exactly,
I
exactly. So,
totally agree. I totally agree. I mean, holding the asset is also, I mean, we talk about this a little bit, and I know it's poison to the ears of a broker, but I think that paying off some debt is also is gonna help you hang in there, but it's also gonna make the early years harder. Because let's say you bought a unit for 600,000 and you bought it in 2015.
mm, mm,
Rent's probably not that much higher. It'd probably be a tiny bit higher. Um, but but interest rates are much higher. So if you're on interest only for there, you'd be you'd feel like you hadn't made any progress. If you bought a $600,000 unit, it's worth $700,000 now, but now your interest repayments are much higher, and you've kind of squandered 10 years of making the repayments easier for you and making you refinanceable. So yeah, I think that there's something in that as well, but it kind of depends on the mix of investment properties versus owner occupied properties as well, of
yeah.
course.
Yeah, personal circumstances as
Yeah,
I come to it. I think
yeah,
and everyone's risk appetite is also different, and
yeah.
age bracket's different, and so on. So there's a lot of factors in terms of debt reduction side of things, right?
Mm,
I
mm,
totally agree. But yeah, I think the main point coming back, it's easy to get in because it's easy to just buy a property, right? Like
yeah,
you just got to have enough resources to get in, but there's number one, the asset selection side of things. You can never guarantee that in 10 years' time or 20 years' time, this property is actually going to double. Plenty of unit examples in Sydney, which it literally didn't move, right? Like for the 10 years or even
mm,
gone backwards, unfortunately, or mining town. So asset selection side of things. And then on top of that, there is the ongoing cost holding of them, and then all the repairs and maintenance and all the issues or
mm,
tenant issues as well. So there's a tenancy side of things. Um, and then yeah, there's other uncontrollable circumstances, like I mentioned, personal circumstances, which could potentially impact it as well. So yeah, there's a lot of headwind, which is why I think, we come to the conclusion that most people or most property investors, unfortunately, could not hold on to the property long enough to be able to really see the gain, the
Yeah.
real compounding effect of property.
Yeah.
So,
What Michael Yardney always says, which is kind of a twist on what we're saying, is that it's simple, not easy. I mean,
mm,
people know what they need to do. They need to sort of buy a property. They need to hold on to it. They need to renovate it from time to time, keep the
yes.
tenants happy, manage their rents. It's hard, and also like 30 years is a long time to do anything. And when you're on a kind of month to month circumstances, 'cause, you're gonna have good years, you're gonna have bad years. So it's simple, but it's not easy. And I think that's pretty spot on as well. But anything worthwhile is not easy. Otherwise, everyone would do it, and owning property is worthwhile. So I
Right.
encourage it.
Mm. Cool. All right. That's a good one. We'll probably talk about exit strategy, or when should we exit, look at exiting potentially as a follow on to this topic, because I think, a lot of property investors will be interested to know. So when should I, like, sure, I'll hold it on to say 10 to 20 years, but when should I look at
Yeah.
exiting, and how do I go about exiting? What will be some of the exit strategies, that kind of stuff that can help them. So touch on that next time. Anything else you want to add, John?
Nothing. Just good to be back, and good to be chatting about property again here in
Right.
Sydney.
Beautiful. All right, mate. Well, thank you, listeners, for joining us today. Hope you definitely got something out of it. If you like what we're talking about, just let us know. Give us a like, or comment below in terms of what else you like to see. Otherwise, stay safe, and we'll see you guys again in next week's Spark Your Fire episode. John and David.